Sridhar Sivaram, I guess my comment was the question. I have laid all the possible fault lines which are logical. If I connect all these areas of concerns and the factors which I have mentioned, then market should be lower and much lower from where it is. Why are markets holding on?
These are classical bear market rallies, and we've seen in the past also that we do get very vicious rallies between falls. So you go back to 2008 or you go back to any of the others falls that we've seen in the past. Also keep in mind that the US market itself has recovered close to 25 or 27, 26% from the bottom. So as I've said in the past, that's the mother of all markets, and you have to look at what's happening to that market. That determines what happens to most of the other markets. I guess in some ways, India is following what is happening there, but I would still maintain that one has to be very careful with such rallies, and you could be caught on the wrong side of the market.
So for those who've not participated in the rally, should they jump in? And for those who participated in the rally, should they cash out? What I'm trying to understand, Sridhar, is that a month ago we used the word panic. Now we are using the word FOMO. Now whether it's a bear market rally or whether it is a genuine bull market, in hindsight we'll figure out. But the bottom line here is that it's a very annoying feeling when you are in cash and when you see markets go higher. What should one do?
I think cash is king. Just keep in mind as to what is happening to economies, not only in India, across the world. These sort of events that are happening across us where, 90% of global economy is literally in a standstill. Our own economy is in lockdown right now. Most companies who've declared results till now have no visibility at all. And most companies are giving a cautious outlook, and we don't know how these things are going to play out. So I think given these uncertainties and the fact that markets eventually sort of reflect what is happening to the underlying economy and as a result to the underlying company earnings, the background is not looking so great. So yeah, markets rallied, but do I need to participate in every market rally? Possibly no, I can sit on the sideline. It isn't as if the economic outlook is so great that I'm going to miss out and, the economy is going to be flying from the next quarter and I'll be missing out on a lot of action. We are going to have tough time for at least a year, if not more. So I'll have enough opportunity and more to pick and choose my stocks, get the stocks at the right price. As long as I don't have the word that you use, which is FOMO, which is if you don't have that and you're patient and you're able to wait when the markets are having a strong rally like this, eventually you'll make money.
It's not a bad start, a percent higher. It's not a bad start. Again, I go back to that same point. Okay, Sridhar, how should one understand the Franklin episode? I mean, now Franklin episode will make sure that mutual funds will find it difficult to perhaps raise money via credit funds or credit risk funds. If that is the underlying thought, then are we looking at a further liquidity crunch in the system? Do you think this will come at a time when the bond market was opening up and after the IL&FS, DHFL and now the Franklin debacle will put everyone in shelter in terms of a appetite to buy into credit risk fund by corporates and by individuals?
Yeah, so at the outset, I don't think the problem is only to the credit risk funds. You look at the funds which have had all these sort of moratorium. Many of them are short-term funds. Forget these. Look at the number of schemes that have a segregated portfolio. The last count, at least 20 different schemes from different mutual funds have segregated schemes. So in my view, the mutual fund industry in general, there are a few exceptions who have done very well, but in general, have lowered their guard as far as risk is concerned. So let's go back 18 months, just when IL&FS crisis had come. And if you see at that point of time, the exposure of the mutual funds to the NBFC and HFC sector was almost 40%. Almost 5 lakh crores of the mutual fund industry was parked into NBFC and HFCs. And what happened when you have such concentration risk? You have losses, which is what we saw with ILFS, with Diwan, with Reliance Home, and many others. And today, where are we? We are at 20%. So the mutual fund industry has adjusted the risk. The same has happened to many other companies, if you see in the last 18 months. And mutual fund industry time and again has fallen short as far as evaluating credit is concerned. Actually, many of the securities that I see in the debt mutual funds, the same funds house equity mutual fund do not own the same security. I mean, I find that very strange that equity is supposed to be more risky and the debt fund manager is supposed to be taking lesser risk. That hasn't been the case. So in my view, the mutual fund industry hasn't really lived up to the risk matrix that they should have. And they already have a 20% facility for redemption. So I think the building blocks were there for them to manage any sort of liquidity. I find it very strange that they cry and say that they've done better than the banks in terms of NPAs. There's a fundamental difference between investing and lending. So I think it is time that mutual fund industry took some responsibility and ownership on how they behave in terms of their debt funds. And if this continues, they'll see significant outflows because there is a panic today. But eventually, I think sanity will prevail. There is enough liquidity. Many of the funds have done well. So I think that people will differentiate between boys and men. That's how I see this. And eventually, I think yesterday we saw Reserve Bank also coming up with some liquidity measures, which is more sort of sentimental value than actual, because I don't see too much liquidity coming from there. But on the whole, I think that's where we are, and I hope things stabilize from here on.
Sure. So, point taken, Sridhar. You're talking about sitting on the sidelines, sitting on cash, this being a bear market rally, and not to really feel FOMO-ish. That's the advice from you. But what are the cues and the parameters that you would look at, which are going to tell you that this is a sign I need to start nibbling into the market or jump in right away?
So I don't think anybody is fully in cash. It's just a question that you don't need to chase stocks in situations like these. But you will find opportunities even in these sort of situations. So one has to look at various stocks, things that you think you like. There are companies which may have had collateral damages and have nothing to do with any of the activities that are going on right now. So I think one has to pick and choose sectors and take a call from there. There are certain sectors which we know which will get impacted, like say NBFCs in general is not a sector that I've liked in the past, and I think they will get hurt more. So if you keep doing these sort of evaluation where you avoid sectors, you may be able to evaluate sectors where you think you will be able to make money, and you keep an eye on those. And then when you get the right price, you jump in. I mean, that's how I would look at it. It's not like the complete market is an avoid. There are enough pockets available for somebody to invest.
So what has been your observation? What can you say is COVID-proof in that sense to park your money in?
So I think the rural economy seems to be holding reasonably well as of now. I mean, I was on a call yesterday which somebody had organized. There were farmers from 8 different states. And it was quite heartening to hear from most of them that actually the yields are substantially up this year, despite the unseasonal rains that we've seen at various points of time, because the water levels were very good. Across the state, these were central and north and Telangana. So most of the farmers indicated yields were very good. So the production is going, so we're going to have another bumper crop as far as agriculture is concerned. Also, states have done a reasonably good job of procuring some of this, at least from the smaller farmers. And some of the larger farmers are having to do more trips to the mandi to sell their produce because of the social distancing and stuff like that. Some states have issues, but I was quite surprised on an overall basis that states have generally done a very good job as far as, because this is the harvesting season and this is the procurement season as far as the government is concerned. and they've done a reasonably good job. So the impact of that is that once these farmers do get money, we will see some spending coming back. Also, most farmers did confirm that they have got the money that the central government had promised as far as some of the relief measures were concerned, which were announced immediately post the lockdown was announced. So I think that surely is a pocket worth evaluating, which seems to have not got affected as much as many of the others.
Also understand how you read into the government really dealing with the lockdown, while the Prime Minister has acknowledged that the lockdown so far has yielded positive results. We managed to save lots of lives. He said that now the economy as well needs focus, and there will be steps taken in order to revive the economy in terms of the job losses and the massive recession that's looming large. How have you read into the commentary or the steps taken so far on that front, and what more is it that you'd like to see?
Yeah, so I think a lot more needs to be done. To start with, I think states need support. I mean, we were on a call with the Kerala finance minister, and it was quite shocking to hear that a state like Kerala has hardly any money to pay salaries now. And when they went to borrow in the market, they had to pay literally 9% for a state bond. Now, this is a sovereign bond which was issued. And if a state has to borrow at 9%, I'm wondering what corporates and what SMEs will borrow at. So the point I'm trying to highlight here is that the current, the way the states operate is that they have to go and borrow directly, and RBI doesn't support. Maybe during these exceptional times, RBI and central government need to allow them to have a larger fiscal deficit, because under the FRBM, they are capped at around 3%. And number two, RBI would need to come and support states, because at the end of the day, they are the ones who are directly fighting the pandemic right now at the state level, because health is a state subject. And also post-lockdown, when the revival has to come, states will play a very vital role. So it's very important that states have a lot of liquidity. So I know a lot of people are focusing on how NBFC liquidity is important, how mutual fund liquidity is important. I mean, after the call, I felt these are all nothing. We need liquidity as far as states are concerned. And of course, the second one is we need to see some sort of announcement from the government on how they're going to monetize the deficit. We are going to have a substantially higher deficit. There needs to be more revival packages. There is a talk that we will hear something from the government over the next 1 week. One would want to see what those details are. I think the fiscal deficit is going to be substantially higher, possibly at least 200 to 300 basis points more than what the government has announced. And we need to see how they raise that, how they monetize it. And those are the details which are more important going forward, in my view.
Sridhar, do you think consumer stocks could also come down, or they will continue to march at a premium, because we know that we will continue to consume food? Now, do we go down the barrel in terms of our preferences? That's arguable, which is that we may start consuming more products which are linked to necessity rather than luxury. We will continue to consume staples. It's not that post lockdown nobody will come out on the roads. We will continue to come out on the roads. So do you think consumers are in this very sweet spot because there's no balance sheet risk there, and in terms of an impact, the impact has also been the lowest?
So my own preference as far as consumers concerned is consumer discretionary rather than staples, because once the risk reward doesn't seem favorable as far as staples concerned, just in terms of valuation. And the reason why I say discretionary is that personal transportation may become a very vital thing post the lockdown being removed. Already in my discussion with many of my friends, some people whom I know who are at the bottom of the pyramid or who are at the mid-level, all have expressed worries about traveling in public transport. So there is a possibility that we will see a demand coming back for two-wheelers at least. But just keep in mind that there's a lot of pain before gain because most two-wheeler companies are sitting on BS4 inventory. Their supply chains have been disrupted. Their dealer network is in bad shape because they've been shut and they need liquidity support. But on an overall theme, I'm just saying that discretionary seems to be something that may come back, especially automobile. And I think the risk reward is much favorable there because demand has been very muted for almost 2 years now. So I think there is also a case of pent-up demand and a specific need that has come up because of COVID. So I think that's a sector which I would watch very closely.
What, to your mind, in this new normal will be the outsized gainer? Everything is not going to shut down, Sridhar. We may argue about a stock being expensive. That's a valuation call. I'm keeping valuation aside. But let's talk about an outsized winner. Like in the NBFC boom, Bajaj Finance turned out to be an outside winner. In the entire migration from PSU banks to private banks, HDFC Bank became an outside winner. In the COVID crisis, when the puck is going to move, where do you think the puck would move, and which company sector is going to be the outsized winner?
So I think this is, you have to see this from a medium term standpoint. So if we go back and see 2008 and post 2008, what happened, you would see that within about 18 months or so, we saw quality started to really do well because the pre-2007 was mostly commodities and infra companies which were doing extremely well, and that sort of shifted. But the shift didn't come overnight. It took some time before the entire trade of staples, of consumer discretionary, of IT, generally quality companies are doing well. I think the same may happen that the initial winners may not be the final winners. I mean, the market will evolve as more data points emerge. In my view, it's possible that a new normal will come as far as manufacturing is concerned, because there is already a lot of talk and discussion about shifting from China. There's also some tensions of US and Europe as far as China and their relationship is concerned. This is a great opportunity for India to capture some of the manufacturing. Whether India will be able to actually do it or not, only time will say. But I think that could be a medium-term winner as far as India is concerned, which is if India can capture some of the global manufacturing is concerned. Keep in mind that we have already reduced the taxation rate substantially. And given that we are now reasonably competitive as far as Asia is concerned. And as far as ease of doing business is concerned, we've seen in the past that it is actually the states which compete with each other in trying to procure the ease of doing business. We've seen a large, Amazon center which opened up in Hyderabad, and it was competing with 3 other states. So I am optimistic that that could be a reasonable winner, but that's a medium term. A lot of data points have to come in, but the building blocks are very much there.
Okay, on that hopeful note, Sridhar, thanks so much for taking the time out and speaking with us today. We'll let you go on that note.